what a week, yeah.
Yeah.
We start with sell-offs and recession fear, kind of, the week, and then there were some positive vibes going on, and then I don't know. Last 2 days was consolidation. I don't know what you call it.
Yeah, these were garden variety corrections. That's an American expression, garden variety, meaning the origin of the phrase garden variety is just anything you might find in your garden, nothing special, right? So garden variety means tomatoes, cucumbers, olives, nothing special. It's not like a Chinese papaya from an ancient jungle, it's just
Okay.
So it's a garden variety correction, and we have these 1 to 2 times almost every year. I can't even think of a year where we didn't have an 8 to 10% move lower. There may have been one, but off the top of my head, I can't think of it. So this is very normal. People tend to panic when
I'm just putting this disclaimer.
Okay. I always stop when you do that. I think something's gone wrong. People tend to panic when things have gone straight up, right? Where if you look at, I don't know, we could put up a QQQ chart, and I will put that up soon.
Mm-hmm.
But things have gone straight up since October of 2023, except we did have another correction between March and April of this year. It wasn't as deep as this one, but it was pullback nonetheless. So when things have gone, and by the way, the bull market that we saw between the October lows of last year and the low of the sell-off in April of this year, the rally after that was much steeper than the previous rally. So that's what causes people to think that the market price action was quote unquote crazy. Okay. They think it was crazy because it's not something that they've seen in the last few weeks. And that's not honestly a very realistic way of looking at things. Losing trades and down markets are the complementary probabilities to winning trades and up markets. One can't exist without the other. If any of you are gardeners or have had family members who have grown gardens or fruit trees or anything like that, you'll notice that they trim the trees so that the bush can grow more healthy.
Yeah.
That's what's happening in the market right now. Now, that doesn't mean that this won't turn into a bear market. It can. Okay. But right now, you don't worry about that kind of thing. You just look and watch and wait and see. If you're a long only trader, you have to wait. If you're a short trader, there might be some opportunities to sell rallies. They might be coming. Okay. And then you hope it becomes a bear market if you're somebody who trades both long and short, because you get to take advantage of these things. But you have to be very careful because, again, the tree has to be trimmed in order to become a healthy tree that lives long. They don't just grow straight up and never stop. Even down here in Florida, we had a close call on a small hurricane, nothing big. It was a Category 1 that hit up north in the Panhandle, and some of Texas. Didn't really hit my area in Southwest Florida at all. And it was only a Category 1. But you see these things coming and you prepare for them anyway. And the markets are very much the same way. When you start to sense things are coming, you prepare for them. And if they don't come, that's okay. No big deal. But if they do come, you were prepared.
Well, what was triggering this kind of movement? During the weekend, we received the Warren Buffett news that he is going liquid. And then Monday, there was something related to Japan stocks.
Yeah, let's talk about the Japanese, what do you call it? The Japanese carry trade.
Mm-hmm.
Okay. And the reason I want to talk about is this, or the reason I want to talk about that is this. A lot of the times on financial media, you see things where people throw out phrases. Okay. Mm-hmm. And they say a lot of this sell-off was the unwind of the yen carry trade. And they expect that people know what that means, right? They think people know what that means. So let me first explain what the yen carry trade is. Okay. And this can apply to any currency, but it's most often this trade involves the yen. Institutions, hedge funds, and high net worth individuals and family offices will go to Japanese banks and they will borrow in yen. So let's say I'd like a 5-year loan in Japanese yen, please. And because Japanese interest rates were 10 basis points, 0.10%, they'll borrow that money with an interest rate of somewhere around 0.2%. Very, very low interest rate. They will then take those yen, they will buy US dollars or euros with those yen, then they will take those currencies and buy assets that are denominated in either euro or dollars, usually dollars, right? So I keep track of interest rates every single day. Every single day I update the US Treasury curve. I have a spreadsheet that is years and years old. I think I'm on cell 8,000 right now, okay? If you're borrowing for, let's say, 2 years in Japanese yen, you buy dollars and you buy a 2-year note in the US. If you did that on July 30th, you get 4.35% yield. Minus 0.2 that you're paying, and you make 4.15% with no risk, except currency risk. Because you know that wherever your home country is, you eventually have to convert the money back into your home currency. So you have to hedge a little bit of that currency risk. Now, as long as the yen is weak, doesn't matter. But when the yen gets strong, you're going to get less of your currency back. So you either hedge the currency by buying the yen, which exacerbates it, or you exit the trade. That's the exit of the yen carry trade. There is a third option. You sell winners in order to not cover the trade that you're suffering from, so your investors don't feel anything. So what do they sell? Well, what's been winners? NVIDIA, gold, ASML, ARM, Apple, Meta. Those have been winners. So they sell those. And then people who have just gotten in that trade recently say, oh, wow, this is going down quickly. I should sell too. And you get a cascade, or what we call a domino effect. Ever seen somebody knock over a row of dominoes?
Yeah.
That's what's happening. So that's why they say that the sell-off was driven by the yen carry trade. Last week, or late the previous week, I should say, the Bank of Japan raised rates for the first time. Well, they raised rates by 35 basis points for the first time in a decade. It was a long time they raised rates by that much. Actually, it was 15 basis points. It went from 0.10 to 0.25. It's not a very big move, but it caused losses for people in the yen carry trade who were in it at the wrong level. And they had to either sell winners or cover their yen carry trade. So that's what they say the yen carry trade caused it, because everything in the markets is linked. No one thing stands by itself. People will say, well, why did Pfizer sell off? What does Pfizer have to do with the yen? Nothing, except people were raising money. If you listen to traditional financial media, you'll hear people out there saying, well, funds are raising money right now. That doesn't mean that they're going to more investors to get more money. It means they're selling things that they have profits in. That's what raising money means. Again, it's the financial world's way of making things complicated when they're not.
Wow, yeah. But thanks to you, it's more clear now. We understand the logic. So as you say, this is kind of traditional sell-off season, kind of.
Yeah, it's very much. So once once people who lost money have adjusted their positions, they stop. And so now we've seen what? Let's call it 2 out of 3 days of rallies. I don't have let me put up my QQQs just to be sure I'm not wrong on that. Yeah, the last 3 days, we've ended with higher closes. Yesterday, we sold off. And I'm counting today, which we haven't closed yet. So 2 of the last 3 days, we've rallied after breaking the 200 simple moving average in the QQQs, but we closed above it. So we ended that day, we gapped lower on August 5th. We ended the day down 2.9%, but we ended much higher than the open. Next day, we rallied, sold off from the highs, but still ended up positive close to 1%. Yesterday, we were down another 1%. Right now, we're up a little bit more than 2%. So we'll see where we end up today. But that's why we're stabilizing. Now, that doesn't mean things have changed. And that's where I could talk about our subject for today.
Definitely. Do you think we are at the dip right now, or this may continue?
I will say this. I told my clients on the 5th to buy the dip. Okay. I said, now this is the part that's important. Okay. Because this doesn't apply to the people in this show at all. So anyone who's listening to me right now, don't listen to me right now. All right. I said, if you want to buy some stocks for your kids to hold on to and put them through college, if they're under 10 years old now, start buying today. That's what I told them on August 5th. And one of my friends called me up and said, great call. You were right. I said, no, I wasn't, because your kid's not in college yet. It has nothing to do with what happens over the next couple of days or couple of hours. But when I see dips like this, I know most of the market is going to panic, and I know there's going to be a short-term bounce. So that's where it sort of applies to this audience, where I had a feeling of a short-term bounce, but I didn't have a trade signal, except that we closed back above the 200. So there is a trade there, believe it or not.
Yeah, good. All right. Thanks for that, Bob. Before jumping to our topic, I would like to remind everyone in the room, please do ask questions. Bob is always happy to answer them. Also, if you have any ideas or topics you would like to see covered upcoming sessions, you can put that on the chat as well. Larry on the chat says, good morning from South Carolina. And Ben, as always, our regular there. Good morning. Good morning, Chin or Chin. I don't know how to pronounce. Actually, it's kind of Chinese name. Good morning, Queen from Toronto. Hello,
Canada. I have a family in Toronto, Canada. I don't know where Ben is from, but I have a lot of family in Toronto, Canada. Italians that came from my region of Italy either went to Canada, Argentina, or New York and Chicago. My family went to Chicago. But I have one of my cousins, one of my favorite people in the world, lives in Toronto with his whole family. And South Carolina is somewhere I want to visit and haven't yet. South Carolina is supposed to be beautiful. Right now, Florida's hot, South Carolina's hot, so I'll wait.
For a short time, I've been in Chicago and Wisconsin and New York. That was my all experience in the region. So I can't talk much about it. So
Ben said he's somewhere in Ontario, so he doesn't want to say exactly where, which I understand. Quinn says, are they good traders? No, they're not traders at all. One is an architect, and my uncle drove a bus in Toronto, Canada for years. We're blue collar people, Quinn.
All right, so our topic is today, trade entries and exits. I know we have covered the rotation zones, trend lines, etc. So if we put everything in one place, what are the most reliable technical indicators or patterns that you use to determine optimal entry points for trade? Especially if there is no rotation zone yet. Some stocks, like in momentum trading, they just spike, and we don't know where it's going to stop or how it's going to be end. So in this kind of situations, what's your strategy? I would like to learn about this.
Yeah, so I'm going to go ahead and put up my screen because honestly, for me, you guys are going to see the top of my dog's head for a second here. For me, if there is no rotation zone, I don't really trade. Okay. All right.
That's right.
But I did say, so here, let's do the QQQs first. You can see the screen now, right?
Yes, you can see.
All right. So this is the QQQs, or as we would call it, the NASDAQ, right? Mm-hmm. So here, we have a rotation zone that formed. Now, for those of, I don't know if Quinn has been in here before. I know Ben and Larry have. Mm-hmm. We had a rotation zone develop here where the blue is the 21 exponential moving average and the red is the 8, and they crossed up. And then we had to move into rotation zone. And why do we call it the rotation zone? Because especially in the early stages of it, price tends to rotate in and then turn back up again. So price is coming down and it rotates back higher. Now, a rotation zone only exists when it is moving at an angle and is widening apart, as it is right here. Here, you guys can see my cursor, right, Badish?
Yes.
There's no rotation zone. The moving averages are there, but they're flat and they're tightening. They're not widening. Here, they're angling up and they're widening apart. So when we get a dip into the rotation zone, I'm able to see a rally from there. Same thing here, rally from there. Now here we go into the rotation zone, but we never break back up, right? We gap lower, and now here we've got it turning and flattening again. So there's no rotation zone. Now let's look, right? I want to zoom into this. Am I zooming? No, I locked it up. Hang on. I want to zoom into this more. All right. See this? The 8 and the 21 here crossed lower. Okay. The red is the 8. The 21 is the blue. The red crossed below the blue. Now remember, these are exponential moving averages. This is not a sell signal for me. Okay. Because the same thing happened in here twice. We had a cross, but the market didn't really move because it was flat. When they cross, they're usually flat. As you can see it right here. See how they're crossing and they're flat and tightening? Well, they have to go flatter and tighten in order to cross. So that is not a signal. If you play moving average crosses, you're going to go bankrupt, okay, because they don't really work well. But what we had then is we had them start to angle and widen, okay? And then we had to move up into the rotation zone, which was also challenging the 50-day exponential, okay? So what have I done in the past? Well, I've drawn trend lines, right? I've drawn these best fit trend lines. Now the trend line, it's hard to draw one because we were starting to get a move up into the rotation zone with this candle and then this candle. But then we never got up in there. We just sort of collapsed. I needed to move into the rotation zone like it did here before I want to draw that trend line in order to play off of. So let me go back to this area for a second. When I moved into the rotation zone here, I take my trend line ray tool and I draw sort of a best fit. It's just best case trend line. And I wait for a positive close above. This one is a negative close above. That is not my signal. Okay. It has to be a green candle. When I get this green candle, I can go long at the close. Okay. And then I can start enjoying this rally higher. Now, we're not going to have time for me to go into targets here. So I couldn't really draw the trend line here for two reasons. Number one, it didn't go up into the rotation zone yet. As a matter of fact, it was far from the rotation zone. It's hard to see, so let me get rid of this trend line, but we hadn't even touched the 8 yet. So that's not something that I can play off of. But then once we got in here, okay, now we're testing the rotation zone, but I don't really have a trend line I can draw, right? So there's no signal for me really here. Then we collapsed, broke down, and then we got down into this area here. Now, I don't have a 200 simple on here because me and Badish were trying to figure out how to put the simple on here, right?
Oh, yeah, it's on me. It's my bad.
It's okay. We'll maybe get that for the next session. But now I'm getting a rally, and you can see the rotation node is still widening, all right? It's still getting wider. The distance between here and here, let me go down in a straight line. Between here and here, and the distance between here and here is wider than here. And it is a sharp angle downward, even though it slightly turns up. Remember, the 8 and 21 are both short time frame moving averages. So even the slightest rally will have them flatten out a little bit. So you're looking at the bigger picture. So now if I get to move into the rotation zone, I can draw this trend line from here to here. Remember, this is the Qs, right? Now it hasn't done it yet, but if I say, and this wick did go into the rotation zone, but because stocks have a natural upward bias, I'm going to be very careful about selling a break of this. Okay, but I'm going to leave this trend line in place because now if I get to move up in the rotation zone and then we turn back and break this trend line, I'm going to have a short that's going to be lower. The target's going to be lower than the low that we have here. I need to look at the date on August 5th. My target will be below this low. Right now, so far, this move from this high to here is around, it's close to 10%. So that's a correction. So a rally from this wouldn't shock me, because you got sort of a garden variety correction, and then that correction makes the tree healthier, like we talked about trimming the tree, right? And then you get a rally up, and maybe the rally continues. But when you look at the overall market, so you can see that one of the things that the Zero Pro platform does really well, it highlights the annual low right here. It's 413 on the QQQs, 413.07, right? That's the year-to-date low on the NASDAQ. If we get below this, we're going to be testing this year-to-date low. And if we break that year-to-date low, you will have another one of those domino effects where there's a lot of algorithms and there's a lot of individual people. And by the way, you rarely hear me say algorithms, because that's one of the ways that people who don't know what's going on explain what's going on. So in other words, if there's a big sale and you've got tons of people out there who don't understand the yen carry trade, they don't understand the effect of Fed policy on assets, they don't understand currency effects into the stock market, they'll go, oh, this is technicals, it's just the algos. Whenever you hear somebody say that, that means they don't know what's going on, just for the record, okay? But algorithms will reach down for year-to-date lows. They will, okay? And then they will sell through that. Now, not all of them, but some of them will. And then you also have people who, I guarantee you that some of you have done this. I'm going to put my stop below the recent low. Well, by the same token, some longer-term traders have said, I'm going to put my stop below the year-to-date low, okay, which again is this 413, right? It's a very simple way of figuring out where a stop should be, all right? We don't do that. We do something a little bit more complex. But I will say that this area right here, when you go over to the left and you notice that there was a reaction here in January and February as well, and then there was another reaction here in December of last year, this is an important area. It is an important price area. So if we get a break of this trend line after a move up into the rotation zone, it has to go up in there first and then turn around and break. All right, then that to me means we're going to get an extended sell-off. Now, I want you to notice something else for those of you that use simple supply and resistance, okay? Here's a resistance level, okay? These lows here. They match closely with these old highs here. Not exactly, but closely. And those of you who know support and resistance know that they're areas, not levels. They also match pretty closely with these old highs here. It's this whole area here. So if this were going to fail somewhere, it's probably going to be in this little area here. Okay. I think there's a tool for me to draw shapes, but I haven't played around with it. So here's a rectangle. All right, that area right there. You can see this, Bodish?
Well, not so clear, Bob.
All right, let me go ahead, and those of you who don't know, you double click and you can make it like a 4 and then it'll show up nicely. Is that better?
Yeah, that's better. Thank you.
See that rectangle? So now we have a combination of dynamic resistance, which is the rotation zone, and static resistance, which is these lows, these highs, and these highs. So static and dynamic makes for a very tough level for the markets to get through. So this is how you identify entries and exit. You don't just say, I think it's going up. You start to do price action analysis on things that you like. I like the QQQs. I told clients and friends that if you want to buy something for your children, buy the QQQs. Why do I like tech so much? Well, because tech is the future value. Okay, Apple was a growth stock until it became a value stock. Amazon was a growth tech stock until it became a value consumer cyclical. it's really a lot of things. It's cyclical, it's discretionary, it's staples, because Amazon sells all of that. But they also have their cloud services, which makes them a tech stock, right?
Yeah.
So tech is the future value. So I like the index for people who are buying things for their children. Now, let me get rid of some of this stuff. Let me go to a stock I like. Is that okay, Badish? Can I do that?
Sure, please. By the way, we have a question from Nima says,
Yeah.
what is the time frame you base your decision on rotation zone and then entries, considering a couple of days trade? So it's kind of swing trade. We actually kind of covered, but yeah, no harm.
Well, it's okay because I don't base it on a time frame.
Mm-hmm.
I base it on whether it happened or not. Okay, so that sounds silly to some people, right? But what it is for me is if this takes 1 day to happen, 3 days to happen, 5 days to happen, I don't care. It just has to happen in the correct way and in the correct order. But I will tell you this. Who asked that question, Badish? Because I can't see the chat.
Nima Babai.
Okay, Nima. If it continues to go up and doesn't rotate down, the rotation zone will disappear. It will flatten out. And then the trade's gone. So that's why I don't worry about the time frame at all. Because it'll either happen or it won't happen. Right? Does that make sense?
Yes, I hope that was answered for Nima as well.
So
and Ben has suggestion for next session.
Yeah.
I propose dividend stocks for income. Good idea or not?
Yeah, we could talk about that a little. I have my reasons for wanting to do the next session, what I want to do.
Yes. But maybe the other one,
Yeah, basically what I want to do in the next session is the 10 most dangerous things that people say about stocks. Now, that was a speech given by Peter Lynch. If you don't know who Peter Lynch is, I'm going to tell you who he was next week. But he's my favorite trader of all time. He's my favorite stock trader of all time. It's not Warren Buffett. It's Peter Lynch. I actually like Warren Buffett's partner more than I like Warren Buffett. He died, Charlie Munger. But that's not a knock on Warren Buffett. I just think Peter Lynch was much more applicable. I have trouble with this word, Badish, I'm sorry. Is more applicable to people like us. The way he looked at markets is much more like your average retail trader. And Warren Buffett looks at stocks much more like a private equity guy, where he buys something that's cheap with his, right now he has $276 billion in cash on the sideline. What's going to happen? You buy $7 billion of something, what's going to happen to him? Nothing, right? Or you and I buy $7,000 worth of something and we end up divorced with weekend visitation of our kids. So it's, Peter Lynch was much more reliable for the retail trader. And he has a couple of good books. And next week, I'll tell you about the best ones. But he started out that speech. He wrote that speech because I knew somebody that worked for him as the 7 dumbest things people say about stocks. And his team convinced him to not use the word dumb. So he called it the 7 most dangerous things people say about stocks. So anyway.
I'm excited about it. Well,
yeah. So anyway, I like Pfizer as a company right now. Okay. But when stocks are weak, all stocks go down. Okay. You've heard the phrase, a rising tide lifts all ships. Well, so does a falling tide. A falling tide drops all ships. Now, stocks are recovering today. Pfizer is not. Okay. Now, I'm going to do something more along your time frames. Okay. Because I know you guys are much more short-term traders than I am. So we're looking at a 30-minute chart here. I'm going to lock it up a little bit here so I can just look at it like this. What I had here in Pfizer is I had a rotation zone develop right here. Now, the gray is aftermarket, right? I had a rotation zone develop here, and then I had no moves into the rotation zone. To Nima's question, then I had no trade, okay? Because I never had a trigger for a trade. It went from here to here. That's one of Peter Lynch's things, by the way. I lost so much money because I didn't take the trade is one of the things that is on his list, but we'll talk about that next week. All right.
But probably you save lots of money that
Yeah.
you didn't enter. Yeah.
Peter Lynch basically said years ago that you can't lose money if you don't take a trade. So he was the only way you could lose money is to take a trade, right? So what am I looking for now in Pfizer? So here is today, right? Well, I don't really have much of a rotation zone at all. So I'm now looking to see if Pfizer develops a rotation zone down, which it had here. This is a short-term chart, or crosses up and develops a rotation zone up. Now, the 50-period moving average is in the way of a long trade in Pfizer. It's in the way. All right. So I'm going to be looking for short trades in Pfizer's until we break above the 50, in which case I would then switch and look for long trades. Okay. That's the basis of it for me. Again, this is on a 30-minute chart. I'm going to put up, let's look at NVIDIA. All right. See what happened here in NVIDIA? Same thing happened yesterday. We got a downward cross of the rotation zone and no opportunity to take a short. Then we got the overnight aftermarket movement. Then this morning on the open, we got an upward cross, and we got a close here, the 10:30 time frame, above the 50, and I've got an upward sloping rotation zone. If I see an intraday move into the rotation zone and I can draw my trend line, okay, let's pretend that I got a move here where there was a little bit of intraday weakness in Pfizer, and I was able to draw this trend line that I will make bigger so you guys can see it.
Bigger or lighter, please.
And lighter. I'll do both. All right. You can see that, right?
Yeah.
Okay. Now, this is not a trade right now. Okay. This trend line shouldn't be here right now. But if I get a move down into this newly forming rotation zone, okay, because this, as this bar closes, this is going to move up and widen into the next bar. And if we get another up bar, it'll move up and widen even more. And then I could take this trend line and I could draw it wherever I get a little bit of a downtrend into the rotation zone. Okay. And then if we go in that rotation zone and break this bar, I can buy, looking for a target above the high that was my initiating point for the trend line. This is why I taught you guys trend lines first, right? So I can refer to an initiating point and say, okay, that initiating point is going to be my first target. What do I mean by that? That's where I move my stop to break even. And then as we get above there, I'll take profits on a turn. Okay, so that's how I do it. That's how I identify entries and exits. I wait for trades. Okay, I don't make trades up. I don't just go, oh, we had a long wick, I'm going to buy it. Okay, what does this long wick tell you about a target or a stop? Nothing. It just tells you that it might go lower. Okay, we had a long wick here. And then the next hour, is it 60-minute now? We had a long wick here. And then the next hour it went up. And then the next hour it went up again. Okay. So they don't always work. Here it worked, here it worked. Well, this is aftermarket. I don't care about aftermarket, by the way. Guy, Bodish, that's another question, how to get rid of aftermarket when you ask the question about the 200. But if I can get, I'm just getting a rotation zone forming on the hourly. It formed on the 30 minutes, but it just barely formed on the hourly. So when I look at it on the daily, let me get rid of this trend line now. I'm still waiting for a cross higher on the 21 and the 8. I'm sorry, the 8 and the 21. As a matter of fact, I'm getting a move up into the 8 and the 21. This again is NVIDIA. So what am I doing on a longer term trade? Well, honestly, I'm going to draw this trend line, okay, because it's into the rotation zone. And if I get a close below this trend line today, tomorrow, the next day, my target for NVIDIA is below the low of August 5th. And that low is 90.89. So my target is going to be a break of this low if I get a close below. That's how I find entries. Now, where would my stop be? Well, on this particular trade, again, this would be longer term. So that means you take smaller position sizes, right, everybody? My trade would be a close above the 50 or a break above the high of August 1st. So I would have sort of a two-tiered close. This is where I would place my close, and this is where I would exit the trade either way if the day was going to close above there, even without breaking this high. Because once we close back above the 50, strong chance that it continues. Not 100%, but it's a strong chance. So that's entries. Now, exits, I do measured move exits, and we'll have to talk about that in another session because we've gone over here. But
Yeah,
measured moves, I probably have to show you on a different platform, but I can show you the math of it. Okay, because I can't really change the measurements here, but I can show you the math of it, and then you can calculate it on the TradeZero. As a matter of fact, I'll show you that in the next session. Not in the next session, but when we go to targets. Peter Lynch is he applies more to the way that you and I in this group in this class, Bodish, think about markets or should think about markets. So because he was much more risk averse. He ran a long only fund. Okay, so he wasn't able to take shorts. He wasn't able to buy 10% warrants during the financial crisis from Goldman Sachs. You know, he wasn't able to do the kinds of things Buffett can do because he had just, you buy stocks and that's all you do. All you can do is buy stocks and sell stocks that you already own. That's it.
makes sense. Nima says, I was referring to the saying that do your analysis on a time frame and answer in 1 or 2 time frame lower. Is that a valid note?
Yeah, it is. So multi-time frame analysis is something that we do. It's actually something that we covered, but we could do another session in the coming weeks on that. So if I set up a potential trade on a daily chart, I can fine tune my entry on a 4-hour, but my target and stops are still calculated on the daily. When you set up a trade, it needs to be on your core chart, whatever chart that is. And then you can fine tune entries on short-term charts as long as there's nothing in the way. So for example, I showed you guys the Pfizer 60-minute, right? And I said, I'm waiting for a long trade. But if that long trade contradicts with the negative tone of the daily, no trade. No trade for me. So in other words, if my target on the long trade on the 60-minute chart is a move above the 50-day moving average, can't take it. It takes too much of the probabilities away. So you can fine tune entries, but you can't create trades on a lower chart based off of what you're seeing on a higher chart because they are two different things.
Gotcha.
Right now, the 30-minute in NVIDIA and the hourly in NVIDIA are bullish. The daily's bearish.
Thanks for that, Bob. I hope, Nima, you got your answer as well. We exceed actually our human time today. Thank you. I would like to thank everyone for joining us today. We really hope that you gained valuable knowledge on trade entries, and we will also cover the exits in another session as well. Special thanks to Bob Iaccino and his special puts on this matter for today. Stay tuned for more TradeZero Live sessions, and happy day, happy evening ahead. Thank you so much.
Cheers, guys.